Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky. If you've been listening to this show for a while, you know we focus on going a mile deep instead of a mile wide. That's exactly why we're buying again in Tucson, our 12th deal in the market. Our latest acquisition, Icon on Broadway, is a 300-unit multifamily community purchased well below replacement cost with day one cash flow and conservative underwriting. We're projecting a 16 to 18% IRR with significant bonus depreciation in year one. If you're an accredited investor and want to learn more, you can access the deal room at breakofdaycapital.com.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes.
Today is a solo podcast, and I want to talk about something that's been on the minds of many investors over the past few years: weathering the storm. I'll go over 5 lessons to be learned from this downturn. You may have heard the saying, survive until 25, or maybe persist till 26, or I'll fix it in 26. Well, that was wrong. If you've been investing in multifamily real estate for any length of time, you know the last few years have been some of the most challenging we've seen in decades. Interest rates rose at the fastest pace in modern history. Cap rates expanded dramatically. Property values declined. Lending became more restrictive. Transaction volume slowed to a crawl. And many operators who looked like geniuses in 2019, 2021 suddenly found themselves under pressure, a lot of pressure. The reality is that cycles happen. This is nothing new. Anyone who's been investing long enough knows there will be periods when everything seems easy and periods when everything becomes difficult. The true test of an operator isn't how they perform when the wind is at their back, it's how they navigate adversity. But every storm leaves behind lessons, valuable lessons. And if there's one lesson this cycle has taught us, is this: not all these deals were bad deals. Many deals were built on assumptions that just stopped being true. Certainly, some operators made mistakes. But I believe the bigger story is that many of the assumptions that seem perfectly reasonable in 2021 don't look nearly as reasonable today. That's why I call these underwriting lessons nobody wants to talk about. Not because they're controversial, but because they force us to confront uncontrollable truths about risk, leverage, liquidity, and what really drives investment performance. The question isn't who got everything right, because almost none of us did. The question is, who is willing to adapt? Because the operators who succeed in the next cycle will likely be the ones who learn the lessons on this one. Lesson number 1, refinancing is a risk, not a strategy. I think this is probably the biggest lesson of the cycle. For years, refinancing was treated as an expected outcome. Property would be purchased, values would rise, rates would cooperate, and a refinance would return capital to investors. The problem is that refinancing isn't something we control. It's dependent on interest rates. It's dependent on lender appetite. It's dependent on property values. It's dependent on debt markets. When rates increased and values declined, many properties suddenly found themselves unable to refinance without bringing significant capital to the table. This is one of those lessons nobody wanted to talk about during the boom years because refinancing was often viewed as a certainty rather than a risk. At Break of Day Capital, this reinforced the importance of maintaining liquidity, preserving reserves, and proactively communicating with lenders long before loan maturities became a concern. Today, one of the first questions we ask is, what happens if refinancing isn't available? Because that's no longer a scenario that can be ignored. And for investors evaluating opportunities today, I believe there are a few important questions worth asking. What is the refinance strategy? What happens if interest rates remain elevated or elevate even higher? What happens if property values decline? And how might that impact the loan balance relative to the property's value? Because when values decline, lenders often require borrowers to contribute additional capital to reduce the loan balance and maintain acceptable leverage levels. And would additional capital be required if refinancing becomes more difficult than expected? Those questions may not have seemed important a few years ago. Today, they're some of the most important questions an investor can ask because refinancing risk has become one of the defining risks in multifamily investing today. Lesson number 2, rent growth can't be the business plan. There was a period where rents increased at rates we've never seen before. Many underwriting models assume some version of that growth could continue indefinitely. Now, not everyone was underwriting 15 or 20% rent growth, but even 3% rent growth had a profound effect when rent growth was flat to negative. One of the uncomfortable truths from the last cycle is that it became difficult to separate operator skill from market momentum. When rents were growing rapidly, almost everyone looked smart. Then supply arrived. Concessions increased, rent growth slowed, and in some markets, rents declined. What many investors didn't realize is that occupancy can remain relatively stable while revenues decline. Why? Because operators may offer concessions such as 1 month free. We've seen 2 months free in Phoenix, reduced deposits, gift cards, or moving incentives to attract residents. That's why we focus on effective rents rather than simply advertised rents. The lesson isn't that rent growth it doesn't matter. The lesson is that a deal should still work even if rent growth is flat or even slightly negative. The best business plans don't require the market to cooperate. They simply benefit when it does. And for investors, that leads to a few important questions. How much rent growth is assumed in the underwriting? What happens if rents remain flat? How much new supply is being delivered in the market? How are concessions impacting effective rents? And how dependent is a business plan on market appreciation versus operational execution? Those answers can tell you a lot about whether a deal is being driven by operational execution or by assumptions about future market growth. Lesson 3, break-even occupancy matters more than projected returns. One of the lessons this cycle reinforced is that projected returns don't matter much if a property can't withstand adversity. During the boom years, most investors focused on IRRs, equity multiples, and projected cash flow. Those metrics are important, but they don't tell you how resilient a property really is. One metric we pay closer attention to is break-even occupancy. In simple terms, that's the occupancy level required for a property to cover its operating expenses and debt obligations. Because when market conditions become difficult, occupancy alone doesn't tell the whole story. A property can be 94% occupied and still experience declining revenue if concessions are increasing and effective rents are falling. A property doesn't struggle because occupancy drops from 95 to 92%. It struggles when revenue, expenses, and debt obligations become misaligned. That's why we focus on the entire operating picture: revenue, expenses, debt service, and the property's ability to continue performing if conditions deteriorate. And for investors, a few questions become critical. What is the property's break-even occupancy? How much cushion exists if occupancy declines? What operational improvements are within management's control? And what assumptions are dependent on the market versus execution? Strong investments aren't just built to perform in good markets, they're built to survive difficult ones. Lesson number 4, maximum leverage doesn't always maximize returns. One of the more painful lessons from this cycle is that leverage works both ways. When values rise, leverage amplifies returns. But when values decline, leverage amplifies risk. For years, many investors focus on projected returns. And what this cycle reminded us is that risk matters just as much as return. That's not always the most exciting conversation, but it's often the most important one. And I hear more and more investors asking me about that. How much leverage is being used? How sensitive are returns to changes in interest rates? What happens if the hold period is longer than expected? How much downside protection exists if market conditions deteriorate? At Break of Day Capital, we've become increasingly focused on stress testing assumptions and evaluating downside scenarios rather than optimizing for the highest projected return. And number five, reserves are not dead money. Before the cycle, people often thought reserves were often viewed as idle capital. Many operators wanted to maximize distributions. Many investors wanted every available dollar distributed. Few things were less popular than talking about holding more cash reserves. Well, today, many investors have a very different perspective. What we've learned is that liquidity creates options. It creates negotiating power with lenders. It allows operators to solve problems without being forced into unfavorable decisions. That's why reserves are not dead money. It's a strategic capital. And in many cases, the strongest properties today are not the ones that distribute the most cash over the last few years. They're the ones with the strongest balance sheets. Investors should ask how much cash reserves are being held, what unexpected expenses has management planned for, and how much flexibility exists if market conditions remain challenging longer than expected. The bigger lesson, if I had to summarize everything this cycle has taught us, it would be the market isn't just repricing real estate, it's repricing risk. The assumptions that worked in one environment may not work in another. And successful investing requires adapting to the reality. The reality is that no operator gets to choose the weather. We don't control interest rates. We don't control cap rates. We don't control lender sentiment. We don't control the economy. I wish I did. What we do control is how we prepare, how we respond, and how we position ourselves when conditions become difficult. That's where we've spent the last several years focusing our energy. Weathering this storm has meant making decisions that weren't always easy. In some cases, it meant pausing distributions to preserve liquidity ahead of future debt service obligations. In other cases, it meant contributing additional capital to strengthen a property's position and maintain flexibility with lenders. It has meant strengthening relationships with lenders long before problems arise. It has meant focusing relentlessly on operations rather than waiting for market conditions to improve. And perhaps most importantly, it has meant communicating openly with investors, even when the news wasn't always what people wanted to hear. One thing we've learned is that investors don't expect perfection. They expect honesty, they expect transparency, they expect communication. Most investors understand this cycle isn't isolated to one property or one operator. What matters is how sponsors respond when challenges arise. The good news is that while values have declined, demand for housing remains strong. People still need places to live. Quality multifamily assets in strong locations continue to perform. And historically, periods of market disruption have often created some of the best long-term opportunities. The biggest mistake investors can make today is assuming the next cycle will look like the last one. The operators who succeed over the next decade will likely be the ones who learn the lessons of this cycle rather than simply waiting for conditions to return to what they were, because the next cycle will likely reward different behaviors than the last one did. I often remind people that wealth is rarely built during the easy years. It's built during the difficult years when discipline matters most. Anyone can invest when everything is going up. The real opportunities are often created when sentiment is negative and uncertainty is high. That's where we are today. Storms don't last forever, they never do. Eventually, the clouds clear. Capital returns, lending markets normalize, values recover. The question isn't whether the storm ends. The question is who will be positioned to benefit when it does. I believe the investors and operators who emerge strongest will be the ones who use this period to strengthen foundations, improve operations, preserve flexibility, and remain disciplined when others lost focus. That's exactly what we've been working toward. Thank you for joining me today. As always, thank you for your trust, your partnership, and your continued support. We'll keep doing what we've always done, staying disciplined, staying transparent, and focusing on the long term. I hope you got a ton of value from this podcast. If so, please be sure to like, subscribe, and leave a comment to help us grow so others get value as well. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.